What's up, everybody? Michael Silva here. We finished half of the year. We're halfway through the year, and it's been a horrible start to the year. It's worst in 50 years, but guess what? Regardless of people saying some more pain ahead, we are about to head into the best trading day of the year. Stock Traders Almanac reported the first trading day of July is the most bullish day of the year over the past 21 years. Check it out over here. S&P 500, Dow Jones, NASDAQ Composite up 85% of the time on that day for the S&P 500, 76% of the time in the Dow Jones, and up 76% of the times in the NASDAQ Composite. However, if you look at the gains, the median gain here is not all, the average. It's not all that great. It's 0.35, 0.3, and 0.24. But hey, it's something to know, right? We might as well get that bounce. We will see. But there's been so much bad data, and we'll get into the charts momentarily. We had the Atlanta Fed come out, right? QT GDP now, it fell to minus 1%. That was from positive. Not that good at all. So what does that mean? Well, Wall Street Journal is also reporting that there's consumer spending is cooling, and it kind of points further to an economic slowdown. You had Restoration Hardware come out today, and this is their second forecast cut in just weeks. In the housing market, Japan industrial production came out minus 7.2%. So a lot of just economic bombs just kind of exploding right here. We have more data coming out tomorrow to be aware of, right? And then we have to look at all these various commodities across the board, right? Everyone's talking about inflation, but what we're noticing here is we're seeing a lot of commodities start to get hit hard. We're looking at 1 month change and 3 months change. So we're getting some heavy hits to the downside, right? So as everyone's focused on these high inflation numbers, and it's likely that, the slowdown in inflation may not be reporting here in the next month, but it could still relatively remain high. There's more people and more reports now focusing on recessionary fears. And if you just take a look at what's going on with the yields, you have the 10-year, 3-month. This thing has been falling off of a cliff, heading very sharply down towards inversion. And remember, this is like the Fed staple. So, and the rate at which this is dropping, by the way, is fast. And that is putting some, and if it's not yet, it will put fear into the market. Take a look here and why this is important. The 10-year yield, right? We talked about these reversal candles, and we're starting to see them back off. Okay, that's the 10-year yield. And what happens when the 10-year yield falls like that? Well, TLT rises. Okay, but what happens even more in depth to all of this, right? The 10-year yield tracks the relative performance of energy and the SPY. So what does this mean? It means that when the 10-year yield falls, the relative performance of energy in the S&P 500 falls too, which technically means that the energy market will probably see weakness more so than the S&P 500. And you can just see the perfect correlation here. And you can see as of recently, energy has been falling as well with the 10-year yield. So if the 10-year yield wants to back off more, well, guess what? Energy, oil, that will probably fall alongside of it. Now, we already know that energy has been the top performing sector, but it came off hard and fast, about 20+%, putting into quote unquote bear market territory. We saw a little bounce, and now we're starting to see a little bit more weakness today. It was down around 2%. Oil was down, also down 3.66%, back to this trend line, testing that 100-day moving average. If these start giving way, it opens the door for further downside, potentially around 92.5, which is that 200-day moving average, or potentially even here at around 85, which is that prior resistance, which could potentially be a level of interest and turn into an area of support. If that is the case, well, careful, because the rate at which oil is going to be moving down will be moving quite fast. You can see the rate of change this month has been pointing down, and you can see the last time when we look at this 12-month rate of change on the monthly time frame, these large spikes up above the 100% marker and then they start turning back around, have resulted in, well, recessionary times. So 1987 crash, I guess that wasn't necessarily a recession, but it was at least I don't think it was a recession. I think it was just more of a hit fast crash. The 1990 crash, .com, financial crisis, and then what we have going on right over here, you can see it's coming off as it stands, at least at this particular point in time. Another chart that's interesting that I want to keep continuing to show is this correlation chart between these two lines, commodities versus bonds, utilities versus S&P 500. When it gets a very strong correlation, it's only happened a few times, which is like a 1-for-1 correlation here. you can see that it happened in beginning of 99, and it started heading back down. That was before the dot-com bust. Right here was the financial crisis, and then we're right here again. Why is this important? Why is it, what's important to note about this? Well, when bonds begin to outperform commodities, utilities, which is a defensive sector, really start outperforming the S&P 500 on a relative basis. Okay, but what we're seeing here and what we've been seeing is utilities is still outperforming the SPY, but it's at the same time that the CRB index is outperforming bonds. So you got to wonder, if bonds start outperforming the CRB index and this correlation starts coming down, perhaps bonds may be a good potential play along with defensive type stocks. But we'll get into that, because remember, when volatility is high, everything could get hit. It doesn't mean that it can't go up on a relative basis, but like utilities in S&P 500, it's been going up, right, from a relative basis, but it doesn't mean that they can't just both fall together and this line still go up. You got to understand that, right? Let's look at the dollar. What's the dollar doing? Dollar came off a little bit today, but it's still consolidating rather sideways. S&P 500, we'll get into that chart here momentarily. We know that the rate at which this moves to the upside, it puts pressure on equities. But let's take a look here at gold in correlation to the dollar. Found this to be kind of interesting. You look at the dollar above, gold below. You can see a cup with handle pattern in bullish context, and you see gold. It is relatively flat on the year, okay? And the dollar's been going up. So this is actually pretty bullish positive for gold, seeing as how well it's been holding up relative to the dollar's rise. But you got to understand this correlation here. It's almost at a perfect negative correlation, where if dollar goes up, gold goes down. So one has to wonder, if the dollar continues this bullish trend to the upside, is gold going to start breaking down from these levels and head lower? It's a very hard thing to determine right now, so we need to just keep a very close eye on the dollar. Now, if the Fed does some sort of pivot or something happens like that, the dollar can just break down, which could send gold straight up. But as it stands right now, gold is still holding around 1,800. That is a very key level to continue to watch. And then 1,880 is obviously a level of resistance to continue to watch. So if the dollar starts coming off, that may lend way to start seeing gold rise. So that's what we got to pay attention to here moving forward. The NASDAQ Composite had its second distribution day after its most recent follow-through day, which was not too far ago, which, gives us about a 95% failure rate of this new low. So we'll most likely take out this new low. We will see if that is the case going forward, right? If we take a look at the SPY, the SPY today got outside of its weekly risk range, got way down there, put a lot of fear out there, but it started climbing itself back up to that lower range. July is one of the most bullish days, so perhaps the S&P 500 still finishes up within its risk range and kind of pairs what it just did recently. We will see. If we take a look at the 15-minute time frame, you can see we just doodle around this level, doodle, big break, came back up, right? There's all that economic data we talked about, and it's just hanging out there. I don't really necessarily see a trade setup here, but I will talk about some trade ideas that I do see here in the near future. Q. Also, you can see Q's broke down, and look at it, came all the way back up. And this was a big breakdown all the way here, putting a lot of fear right out of the gate on the gap down, started selling off right away. I was looking down here for a gap fill to play up into this 285 range, the lower expected move, and we actually got that. So positive little trade today. If you look at the 15-minute time frame, you can see it a little bit more clear. I was looking at this gap to get filled. We didn't fully get there, so I didn't get a level into a full position, but I did take a small position as it was coming into this prior price action, and then we just started ripping, and we ripped right back up to the lower risk range. And guess what? It started defending it like it flipped positions, right? It could potentially act as support. Now it's potentially acting as resistance, right? It's a key level to watch. So we'll see here if we can get back within that, obviously come tomorrow. Keep in mind, right, it's Friday, start of the month. It's likely to see bullish activity based off of seasonality. But as it stands, like at this particular point in time, if you want to have a good holiday weekend, don't go too heavy into it, because there can still be a lot of volatility given that there's still a lot of economic data to come out, especially come tomorrow, okay? So just be careful, right? There's no rush. If we take a look at the IWM, it did reach down outside of its expected range, closed back within it. If we take a look at the 15-minute time frame, you can just see here massive volatility throughout the day, chopping back and forth. The volatility on all these indexes are still Russell vol, NASDAQ vol in the 30s, and then you have, VIX is just under 30. And this is where I kind of want to get into some trade ideas that I'm kind of seeing take place. K-Web, right? So these are China equities. You can see here kind of building a kind of a basing type pattern, and it's pulling into that 200-day moving average. So this is something to continue to watch. It doesn't mean that the trades are setting up right now. Perhaps, right? Depends on how you play it, but you can see we had the 2050 crossover, pulled back again. We're starting to see some volume come in. The MACD looks like it's about to have a bearish crossover, but we'll continue to monitor. It's still above that 0 marker. RSI is above 50. So we're seeing some strength here that we want to continue to pay attention to. Another one to look at is FXI. This is China Large Cap ETF. Those are a couple of ETFs you can pay attention to. Or, if you're crazy and you want to do 3 times leverage and you know how to trade that type of stuff, you can look at Yin, YINN, or Ying. I know there's a Yang too, Yin Yang. There's a YANG, and I think that's the bearish side of this, but you can see very similar type pattern. Then if you look at individual equities, you can see stuff like DD, right? This used to be a hot stock. It's starting to base out here, pull back a little bit. These are all something that could be keeping a close eye on. This now trades in the OTC market though. Futu Holdings was also another big player. It's also breaking out of these long-term bases, getting back above the 200-day moving average. This stuff could fire off here, and I like these bases that are building, but it's not just equities in China. You have stuff like biotech. We've been seeing some strong relative strength. It's starting to pick up. You saw a strong move. It's starting to flag. It's rather just consolidating, still well below the 200-day moving average, but it is something to start paying attention to as the market is trying to find a bottom potentially, right? Remember, if the VIX starts shooting above 30, these things can all get hit right back down again. But that's IBB, right? That's an ETF. And then you have something like a pharmaceutical ETF, which is similar to various healthcare ETFs like XLV. But PPH, this is pharmaceuticals ETF. And you can see here it's been going through a very choppy period. But we can see here, if it starts getting above some of these key levels like 80, this could be considered a double bottom. If it gets above 80, we can start rocketing back up to that 84 level. So that's something to at least, potentially pay attention to moving forward. So hope today's episode helped out everybody. I'm going to be getting more in depth on tomorrow's episode, which is a weekly recap. I'm going to do the quarterly recap and so forth. But there's just a lot of things taking place in the market. So please, just as always, be careful.